Yo, 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 you are now tuned into Options Gang Radio. I believe this is episode number 8. A nigga like me lost track. I gotta, first of all, want to apologize to everybody for the long hiatus. You know, we got the newborn, shouts out to my son Kenzo. And, this, for those who don't know, I also, run a digital event production company on the side as well. So, I had some events, I have some events coming up with that. And so, shit's been really busy. I've been like super, super busy. I want to start, I'm starting to work on that book for y'all, the options trading book for y'all. I want to get that, right and ready for y'all by Christmas. So it's a lot of, I'm doing a lot. I'm doing a lot of things right now, and I'm just, trying to balance it all out. But I just wanted to start off by apologizing to y'all. I should have took this long of a break, a hiatus, whatever the fuck you want to call it. But I definitely promise in the future, to definitely be a lot more consistent with this. You could definitely expect content to, keep coming out regularly. And, we just going to keep it going, keep getting this bag. You know what I'm saying? That's what we do. So on today's episode, we went a little bit different. I actually reached out into the gang and tapped in one of our Tyler's been he's one of the OGs in the gang, and he's just a super bright kid, man. This dude's just a young prodigy. Tyler was fucking with the gang from 17. Like, he was in high school in class with us trading and shit. Like, we grown ass adults trading while we at work and all this shit. Tyler was in class, high school and shit, trading with us and shit. And to see his growth, to see his development, he's a beast now. Like, now he's like a legit certified beast, and he's just super, super bright with it. So for those of you who aren't, in the group and haven't been privy or blessed to know the shit we know, Tyler's been killing it. Like, he really just went ham on this earnings week, and he made money off of earnings week, playing the game a very, very conservative way. Like, Tyler's in options gang, and he fucks with the risky plays with us, but Tyler's definitely a lot more balanced, and he has a much more conservative approach to the game and a much more balanced approach to the game. He really kind of makes money on, all different ends. So what we wanted to do, I've been talking about doing it in the group for like a week and a half, and I just never got a chance to do it. But what we wanted to do is, like, a lot of the plays he was doing in the group, people had questions, and a lot of people couldn't necessarily kind of, sometimes it doesn't really get across that good in text. They kind of couldn't, get a full grasp of what he was doing. So I figured, like, fuck it, we're going to bring Tyler on the show today, and we're going to have him, chop it up and kind of break down his approach to selling premiums, to making money off of premiums on options. And, without further ado, we about to just get into it. God damn, son. Oh, my God. All right, man. Now I'll press record. Yo, for y'all tuning in, man, I just dumbed out, man. Me and Tyler were going in for a minute, and I didn't even press record, man. So that's on me. But
oh, good. Let me know.
Yeah, but right now the record button is pressed. So everybody, for y'all tuning in, man, as promised, we got the young guy, young Tyler, T Bucket Capital, you know what I'm saying? Depending on your business relationship, you might know him by different names. But we got Tyler in the building. What's good, Tyler?
How you doing?
Good, man, good. So as we were discussing before I forgot to press the record button, I wanted to get into a strategy and approach to the game that you take that isn't traditional. In options game, we always share all our plays, but it isn't traditionally the approach that I take to the game. And it's also something, it's not something that I don't necessarily do. I do it once in a while, but it's not like my main bag of tricks. But it's also something when people get into the options game, the options game in general, it's something that's kind of confusing for a lot of people. A lot of people don't necessarily have your educational background. I mean, even though for y'all who don't know, Tyler's super young, but he's light years ahead of the game when it comes to trading and this whole fucking game that we in, this whole finesse game that we in. But a lot of on the other side of options, you know, we buy and sell options. But there's a whole other side of options. Those are the people that are writing the contract. So that's when you go into Robinhood and you look at the top two columns and it says buy on one side and sell on the other side. The people who are on the selling side, those are people playing the game with strategy similar to what Tyler's doing. So Tyler's on the selling side. So anytime you had a contract that expired worthless, the person you paid to get that contract is probably somebody like Tyler playing that stock that you just took an L on. So when you're playing that side of the game, you're not necessarily looking for a run up or a run down. You're more looking for time to expire because you want the contract to expire worthless so you could keep the premium. So for those of you who don't know, because if y'all not in the group, this past earnings seasons that we had, Tyler just went, correct me if I'm wrong, was it 11-1, 10-1? I'm not sure. What was it?
9-0 earnings in the last week and a half, 11-1.
Got you. So the earnings, you went 9-0, and the last week and a half you went 11-1. So I just, before we get into everything, we'll start off with, I just want you to start off with, what was your approach going into earnings season with this strategy, and kind of just get into what you did, and as you go along with it, I'll ask you questions to try to clarify things for people who may not understand what you're doing.
All right. So as you're approaching an earnings, you have a lot of people are buying a lot of premium. As you see in the group chat, everyone's playing earnings by buying premium and all that. And when premium is bought, it increases the implied volatility, theoretically making the contracts more expensive. So when I look at earnings, high IV, I'll explain the IV rank, which is what I look at in a little bit. It basically just compares the current to the low and the high for a certain period of time. But then I look for high IV, and then there's this Twitter account that tweets out the implied moves based off earnings, and I'll look to go 15 to 20% higher or lower than that just to give some wiggle room, because I'm not going for home runs here. I'm just consistently stacking gains and gains.
So just to clarify, you're looking for something 15 to 20% higher than what?
The implied move on earnings. You can find it on Options Millionaires Twitter.
Got it.
If I was at school, I'd use my Bloomberg terminal, but campus is closed. So.
Got it. So now, when you're looking up these, all right, so let's go into the implied volatility. So for people who don't know, they have the implied volatility of a stock. Whenever you have a stock that's shooting, you know, super volatile, whether it's going up or down, it raises the implied volatility in the contracts. That happens, like Tyler said earlier, it happens a lot of times at earnings, leading up to earnings. Or, you know, right now, you know, with Tesla and Apple, with the stock splits, you have, you know, a lot of people buying in, so premiums get raised. And, I mean, implied volatility get raised. And what happens as an after effect of that is the actual price of premiums gets inflated. So, based on what you're saying, Tyler, you're trying to, and correct me if I'm wrong, you're trying to take advantage of the increased inflated price of the premiums by selling contracts at that price and basically banking on them to expire worthless.
Exactly. You're taking advantage of the inflated premiums with a high IV. And most of the times, there's only a few times where I actually won't let them expire. Sometimes I'll exit when they're only worth like $2 a contract, because for that much left to collect for the buying power it takes up, it just doesn't make sense to hold that when I can start looking for next week's. So usually I won't let them expire worthless if they're really cheap. If not, yeah, I'm looking to take advantage of the high IV, which generally has higher premiums.
And for those listening in, how would someone exit that position? Because people are used to just, you know, buying an option and selling it. But now if you're selling the option, how do you exit that position?
So you buy it again, but you want to make sure if you actually have an open short option position that you select buy to close.
And what would
So
happen if they don't select buy to close?
I've never personally tried that. I'm not sure if the order will even go through. I think it might be rejected by brokerage, but because I'm not sure how it would work if you have a short option position at the same strike and then a long at the same strike.
Got it.
I don't think the brokerage would accept it.
Got it. Now, also, one key characteristic about when you're entering positions like this, are paper losses, right? So, what can you? Can you go into paper losses and how paper losses can still reflect poorly in your account, even if you're in a good position?
So this happens a lot when I play Tesla. Is I'll get in a little too soon, and then I'll see Tesla spike up 15%, and I'll see my contract is down 1,000%. But that's just because you spike up in a short period of time with an increase in implied volatility, and you have a lot of people who are just entering these strikes because they think it's going to run and they're trying to do lottos. So it'll show your account is down. It'll show your account's down a few $100s, but in reality, it's really not. As long as you don't exit the position, if you let it expire, you will be completely fine.
Got it. So going back into taking a couple steps back when you were mentioning implied volatility, let's go into the IV rank, where you find that at, what numbers or characteristics in the IV rank kind of give you the go ahead or the green light to enter a position or something that you're looking at.
So Tastyworks gives me that. That's the brokerage I use. Actually, it was started by the founders of Thinkorswim. That's another popular brokerage a lot of people in the chat use. So basically, IV rank, it looks at the low and the high implied volatility for a certain period of time. I think it's either 30 days or a whole year. And it compares the current levels of IV to the low and the high. So if the low is 30 and the high is 60, and the current IV is 45, the IV rank will be 50%. And right around 45 to 50% is where I'll start to sell. Anything above 50, I usually always sell.
Now, when you're going to sell these positions, are you only selling on one side of it? Are you only selling calls? Are you only selling puts? Are you doing spreads on each? How are you approaching these?
Usually, they always, by Tuesday or Wednesday, because I usually look to sell on Monday, by Tuesday and Wednesday usually always end up being short strangles, which is a short put and a short call. Because when I enter short puts, that is usually the initial buying requirement. But then if I go and look to enter a short call, it takes very, very little extra buying power to enter it because I already have that short put open. So if I usually enter short calls. If I'm buying a short put, I'll usually enter short calls for like $10 or $15 a contract just to make a little bit more, and I'll do it super far out of the money.
Got it. And with this strategy, you're making money on both the short put and the short call as long as what happens. Because if you're doing that strangle, what needs to happen in terms of the price direction and the price that you have your short calls and your short puts for you to make money in that situation?
So basically, actually, this is the current play I have open. So I have a short strangle on Spotify for August 21st, which is this coming Friday. It will expire. The short put is a $210 strike price, and the short call is a $320 strike price. I think I sold this last Thursday. I collected $100 on it, and basically all I need to collect that is for it to stay between $210 and $320 by Friday.
And what's Spotify at right now? I don't even have my shit open.
It closed Friday at 251.32.
So that's a pretty wide range. So it'd take a miracle for it to either go hit on either side of that.
Yeah, it'd have to take a massive market correction basically to happen, because I don't see Spotify dipping $40 in a week just because of all the plays they've made lately with all the podcasting signs and all that. So
now let's say worst case scenario, if it did go up, or go down. So let's say if your put got put into the money, or your call got put into the money, what would happen to you? How would you react?